The US dollar is proving its dominance once again after a continued bullish run has taken it to a 10-month high. Hello and welcome back to our channel. My name is Daniela Hathorn, and in today's video, we are going to be looking at the US dollar. As I said, it has seen a continued bullish pattern, which has taken it to a 10-month high in the dollar index, aided mostly by the rise in US yields. But before we get into this video, please like and comment, subscribe, and turn on your notifications. As I was saying, the dollar index is now at a 10-month high, aided mostly by the rise in US yields. The 10-year yield actually rising further, now at a 16-year high, the highest it's been since 2007, just before the great financial crisis. So a lot of momentum seen in yields. And of course, we know that yields have a gravitational pull on other markets, mostly taking the dollar up and dragging on the likes of gold, the euro, stocks, both in Europe and in Asia as well. And I think looking at yield is the key to go in this recent push, because if we wind back to a year ago, around October last year, we actually came to a little bit of a plateau in the momentum that had been up in that point. And it feels like yields peaked back in October. It felt like we'd come to the potential end of the tightening cycle from the Federal Reserve. At least they shifted their commentary, their perception from being consistently hawkish and consistently delivering rate hikes without any thought or concern. And then in October, we started to see the messaging turn a little bit, suggesting that potentially the terminal rate was in sight, and that the data was showing that the impact of rate hikes had started to caught up to consumption and to households. Inflation potentially was starting to peak as well. So in October last year, we saw what we thought was going to be the peak in yield. We then started to see them drop in the beginning of this year. And of course, once again in March, we saw that peak higher because of the banking crisis. We know a lot of that brought on by the rapid rise in yields that we'd seen over the previous months. So, of course, that saw yields spike up again, but they came down back after that, and they kind of plateaued at the around Easter time. But they have been on a steady rise throughout the summer. As I said, the 10-year yield now hitting a 16-year high, which is very significant. Again, it's a little bit unsure exactly now where they're going to peak. There is speculation that it's going to peak around the 4.6% mark. That is currently where we are. Speculation that we will indeed actually reach the 5.5% region for the 10-year yield. So, of course, still some strong momentum expected in the fixed income market. And as I said, that is having a gravitational pull effect on the US dollar, helping it to push higher. Been on a strong bullish rally since mid-July. We have seen a little bit of some retracements along the way, attempted sellers coming in. But of course, that just alludes to the sustainability in the move. The fact that we do have those instances where sellers have tried to come in, failed to take advantage of the move. And we've seen that push upwards once again really cements that move even higher. Now, looking elsewhere in the market, we know the stock market tends to underperform when yields are rising. And we've seen such a strong performance in the stock market in 2023, a lot more resilience than originally expected. Most of that actually led by the tech sector. It's been a market with very limited breadth. It's been led by the few, and those few being the Magnificent Seven, the big hitters in the US. But those are viewed more actually as safety stocks than risk stocks. If you look at the way their cash flows perform, and just essentially the perception that these companies are too big to fail. So we have started to see in the last few months a shift potentially to a little bit more of a safeguarding capital. If we look at the Russell 2000, actually flatlining there now its performance since the beginning of the year. So pretty much no gains so far in the 9 months after that volatility that we've seen. So we are starting to see that risk profile changing in the stock market. And we are potentially seeing the stock market, and especially the tech sector, dipping over the last few weeks. So again, a little bit of a shift that's alluding as well to a little bit more demand in the US dollar, seen traditionally as a safe haven within the US. And I think one of the key determinators, or one of the key events that is going to determine the momentum over the next few weeks, as it has over the last year and a half, of course, is the Federal Reserve. What's going to happen to rates? Are we going to see further rates? Are we at peak rates? As we know, in the meeting in September, they did deliver a hawkish pause, which is essentially no hike at the meeting, but hinting at further rate hikes possibly down the line. Looking at recent commentary, we had the Fed's Kashkari on Monday saying that rates should probably rise again given the resilience of the US economy. Of course, that's helping yields push up further, the dollar stays supported. And it's just a case now of how long are rates going to stay at these levels. We've kind of got over that period of how high are they going to go or how quickly are they going to rise. We're now at that point of how long are we going to hold them here, regardless of whether we see one or two more rate hikes. And I think the messaging that we're seeing is that at least for a while, we know from the Fed's updated dot plot, we aren't expecting any rate cuts until the latter part of 2024. That has gone down from 4 cuts to 2 in the next year. And of course, the dot plot is just a guidance and rarely actually dictates how it happens. But the fact that the Fed has cut out 50 basis points of cuts next year does allude to the fact that they believe they can keep rates on hold at high levels for longer, keeping monetary policy restrictive and hoping to get inflation back down to the 2% mark. Now, in terms of central bank divergence, if we're looking at the Fed and the ECB and the Bank of England, I think one of the most important things to note is whether inflation is being able to be brought down without hindering growth or without causing too much damage to the economy. It feels like from the data we've seen in the US recently, we're seeing that resilience in growth. We're seeing that resilience in consumer confidence and spending. The PMIs are improving. It feels like the US is there. It feels like the Fed has managed to do that, bring down inflation without hindering growth. It doesn't seem to be the case for the ECB and the Bank of England. They're in much more complicated situations, especially the Bank of England. Inflation is still highly, highly elevated despite coming down. And they did actually decide to pause at their latest meeting. Growth in the latest readings has shown stagnation, no growth at all. And the ECB, again, still have inflation much more elevated than the US. And we are seeing growth struggling as well. We've seen the manufacturing sector struggling. And although those are expected to improve over the coming months, the same as the balance of trade, if we're looking at a central bank comparison, it feels like the Fed has really got the upper hand here. And of course, that is helping the dollar as well, especially if we're looking at the euro dollar and cable, which are such heavy hitters within the dollar index. So that is pretty much what's going on at the moment. And I said, still very much central bank focus, monetary policy focus, looking at how yields are performing. But let's jump onto the chart now to look at some of these key pairs. Okay, so let's start off with the US dollar index chart. So just so we can have a look at the momentum. As you can see here, as I was saying, building from mid-July, seeing that strong bullish pattern here, higher highs, higher lows. We've seen some consolidation along the way, also some pullbacks and retracement, again, alluding to the sustainability and the health of this rally. Because sometimes when you see a very, very strong mood, whether it's to the upside or to the downside, a little challenge to that move and to that momentum, usually you then get a reversal that undoes a lot of that move because it lacks sustainability. And when you see this momentum that has been building over time, and as I said, has been tested and even then proven to be dominant, then that is usually when you see the more sustainability within that move. So the bullish rally continues again today. We're seeing a little bit of a retest. Not surprising. We have seen a good 5 daily sessions here of consecutive gains. Little challenge along that up move. And of course, on the back of those recent moves in US yields that we've seen, the US dollar tracking along nicely. So it looks like that momentum is going to continue. The RSI, as you can see, heavily overbought. Not as much as what we saw back here in September last year along those highs, but definitely heading into that territory. So today's move and potentially a little bit of consolidation over the next few days will help to rebalance that and potentially allow buyers to regain that upside momentum. Looking at the euro dollar, again, one of the big heavy hitters in the dollar index, you can see this clear downward pattern pretty much is a reverse of what we've seen in the dollar index. As I said, it is it does account for the majority of the index. And as you can see here, from mid-July, that clear downward pattern, we've had a few instances where we've tried to rebound and clearly marking this descending channel. As you can see back here at the end of August, we attempted to break higher, found that resistance of the upper bound of the channel, came back down and then was held pretty much halfway on the bottom half of that pattern. The break lower, again, looking for a little bit of sustainability, reversing some of those losses today. Similar thing with the RSI on the flip side here, coming back in from that oversold territory. It's likely that we see those buyers trying to take hold, retesting the appetites, and sellers likely coming back in once again, looking to push even further, now sustainably breaking below the lows back here in March, potentially looking once again to head towards that parity line, that one level. It's still a way away, and we're going to have to see a lot more momentum to come in over the coming weeks to get there. But it does look like we are seeing this decisive push lower take hold. We may see a little bit of a change, as I said, improving manufacturing conditions and also balance of trade conditions. It's going to be a lot of focus on what the ECB does as well. How do the Fed and ECB compare to each other, and which one is going to have going to be seen as the most successful in bringing down inflation without hindering growth. So far, it's the Fed, as I mentioned, and therefore we've got that upper hand of the US dollar, also taking in some of that safe haven coming in from that move away from stocks. So far, it looks like the momentum is going to continue to the downside. If we're looking at the British pound, again, similar thing here. We've got a lot more of a trade playoff here, especially in terms of rates. We know the Bank of England struggling to keep inflation under control, and even then delivering no rate hike at their latest meeting. Traders and investors slightly put off by this, seeing a little bit of increased risk in UK assets. As you can see, since that Bank of England meeting last week, we have actually seen that pullback intensify. Similar momentum today, attempting a little bit of a rebound, of course, bringing in that RSI from those oversold conditions. I wouldn't be surprised if we see a few sessions, especially this week and heading into next week. It's a quiet week on the calendar, heading into the jobs data at the end of next week. So it's likely, I wouldn't be surprised if we do see potentially this rebound taking hold a little bit, sideways consolidation, finding appetite for the next move. But just looking at the fundamentals, it looks like the sell-off hasn't really concluded just yet for cable. That is it for today's analysis on the US dollar. Thank you so much for watching, and don't forget to subscribe to our channel.